Hello, my friends. Brett Pattison coming at you from the financial capital of the West, the land bountiful, where the chairman and I are headquartered. Hey, chairman.
How you doing, Brett?
Oh, living the dream, brother.
Good.
Living the dream. We've
And we
got
got
our partner in crime. I shouldn't say crime on a financial podcast, though.
Yeah,
that's
I know
not
Our
what you mean.
our the other guy, Mike Follett, is down in the land southward. Hey, Mike.
Yeah, south of you by about 30 miles. And I appreciate not having to make that commute on a daily basis.
Yeah, yeah.
Technology is wonderful.
yeah.
Hopefully,
Technology is wonderful. In fact, we're going to talk about technology today. It's going to be great. But let's
right?
let's start with a market update. I'm going to tell everybody what the S&P and 500 and Nasdaq are so far year to date. We are down on the Nasdaq 6.5%, down on the S&P 5.17, which which has come up a little bit, and we'll talk about that here in just one sec. But the S&P 500 from its highs, so from its all-time highs, we're down 7%. The NASDAQ from its all-time highs, we're down 9.3%. And by the time you're listening to this podcast, it might be a little bit different. But right now, as it stands today, the NASDAQ is up over 3%, and the S&P is up over 2% because the Iranians sent a tweet saying, hey, we want to negotiate. So in a world of tweets where we don't know what or who you can trust, this market is up, but very well may be down in an hour.
It's alleged tweet. We it's not verified, so we'll see.
Yeah.
Yeah.
You can't trust anyone's tweets,
What can you trust?
but you love the volatility it creates for the reasons we're going to talk about today. And while we're speaking of tweets, my favorite tweet of the day is from famous investor Michael Burry. Made famous. Who was the actor, Mike, in that movie, The Big Short?
was it Christian Bale?
Christian
Yeah.
Bell.
Yeah, it was
Made,
Batman. Yeah.
yeah,
Yeah.
Batman. Christian Bell, made famous in The Big Short. He's been short for a while, short certain stocks. He sent a tweet out today while we're talking tweets that he's covered his shorts. He's now long or just not bearish, which means nothing to us, but interesting. All
Yeah.
right, let's start with this, guys. Brian, you have a man crush on a how old's Buffett now?
94, I believe.
A 94-year-old
Yeah.
who was on CNBC with Becky Quick, and his mind's sharp and his speech is a little slower than normal. But what would you expect from a 94-year-old who is, in my mind, clearly in charge? Maybe you guys disagree. Clearly still in charge of Berkshire Hathaway, and is the decision maker there. I don't know. Would you guys disagree with that?
Oh, I think everything. I think Greg Abel talks to Buffett probably every day and talking about ideas that he has and yeah, I don't think any big decisions are being made without Buffett's knowledge of and probably blessing
Yes.
a big
Yep.
decision.
And
Yep.
why wouldn't you? Right? If he was still able, right? If he was still capable, his mind's there, why wouldn't you?
Good.
Right.
Good point, Mike.
Yeah. Yeah.
Great point. I would. Yes. So when you're 95 years old and you're a little talking like this,
Gravelly voice.
I might still come in your office and harass you,
Okay.
Chairman.
Okay.
All right. So Buffett on CNBC this morning with Becky Quick, he talked about a few things, a few interesting things that we'll hit real quick, and then one important concept that we want to talk about today. He said that he sold Apple too soon from his portfolio.
I could have told you that.
I love him because he's honest, right? Like
Yeah.
that's what I love about Bud. He tells you the good and the bad that he does, and I love that transparency. But he said he sold Apple too soon, which was interesting.
Well, I mean, that's something that I have felt as well. And I think you had mentioned that he sold it because the position got too big.
That's what he said this morning.
Yeah.
Yes, which is weird.
Yeah, it seems a little contradictory to kind of his philosophy over the years. But I mean, it did become a big part. But Apple, in terms of the whole operating company of Berkshire Hathaway, I don't know that it became that, too big. But
Too large in
in
there.
in his mind, it did. So
Yep. Um, Other interesting thing, and maybe it's just interesting to me because I agree with him. He said the 2% inflation rate that the Fed targets is dumb. It should be 0% because 2% still has an impact on people, which I completely agree with. Some New Zealand economists made 2% up, and the Fed says, hey, that sounds good. So they use it. But Buffett obviously doesn't like that. But the most important part, he talked about market volatility. And the market is volatile right now. And I mean, it's up and down and has been mostly down over the past, really since October. But he said this regarding Berkshire Hathaway. He said over his career, he's had 50% declines in Berkshire Hathaway. When asked about the current market volatility, he said it's nothing. So I want to pause there. Is it nothing? I mean, what do we think? Is the current market volatility nothing compared to what he's saying, 350% declines, or let's just say in market history that we've experienced ourselves?
Doesn't feel like it's nothing, right? When you're losing money and you're feeling those declines or you're experiencing those declines, they represent a lot of pain, right? You feel that pain. But I do think he's a wise man who's been through a lot of volatility in his life, so I think you can put it into perspective. Many investors, they can't do that as well, right? But it's almost like, and you tell me if you've experienced this, but it's almost like when you feel the most fear or are experiencing, if you can think back when you've experienced the financial pain in your life, right? Aren't those, in hindsight, aren't those some of the best times to actually get involved? It's almost like the pain or the fear should
Yeah.
be an indicator, if you're a long-term investor, that is, right? But that should be an indicator where, that's probably a pretty good time to consider being invested if you're not already.
Yep.
I don't know. It's kind of an interesting thing to think back and kind of remember the circumstances where the pain's been there and what the outcome has been.
Yes. Yes, but oftentimes just because the way we're hardwired, we humans have a hard time thinking 2, 3, 10 years out. More like 2 days to 2 weeks out is their mindset,
Yeah.
which makes it
Yep.
difficult that way. But
I would.
you're absolutely right. Go ahead, B.
I was just going to say that uh, to kind of back up Buffett's thoughts there, that it's nothing in the sense it is nothing in the sense that these happen very regularly. These 5 to 10% corrections, they happen quite often. And so if you're an experienced investor, you've experienced these type of corrections regularly, at least probably on an annual basis. And I think you have to sort of have those built-in expectations that these things will happen quite regularly. You will have 5 to 10% corrections yearly. I think almost every year. In fact, we've talked about the average from market high to market low, and every intra year is about a little bit more than that, like 14%, something like that.
Yep. Yep. Okay. Perfect. I love it. That sets us up perfect. Peter Lynch. We all love Peter Lynch. Managed the famous Magellan Fund. I don't have those returns in front of me, but insane portfolio manager. He wrote a book. Was it called One Up on Wall Street? Is that what it was called?
Yeah,
Yeah.
yeah. And
One
he's
Up
the
on.
guy with this very kind of unique hairstyle, this pure white hair, and but really interesting guy. He was when I was pretty young in the business in the '90s. He was the kind of the Warren Buffett. I mean, everybody. It was
Yeah.
Peter Lynch. He was an all-star investor in the '90s. Yeah,
Yep.
I think he did
Fantastic
about
investor.
30%, didn't he? Every year, maybe
yeah,
29%.
yep.
year over year. I mean, amazing result.
Right.
Large chunks of money.
Right.
That's the other part.
Magellan Fund was the biggest fund in the world at that time. It was, yeah, it was big.
So a great portfolio manager with a great track record. Most important, an even kill about him when the you know what hit the fan, right? And so what we want to do is we want to play a quick soundbite from Peter Lynch talking about exactly what we're talking about, which is the volatility. So we're going to listen to this, and then we'll come back on the other side and talk about what we learned.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. So I think that's the key to element. Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor. You're not sure this Walmart can make it. You want to check. You see them operate in small towns. You're afraid they can only make it in 7 or 8 states. You want to wait till they go to more states. You keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money. But you could have waited 10 years after Walmart went public and made over 30 times your money.
All right, there's Peter Lynch with his great gray hair, Brian, that you loved. It's kind of a gray fro. I like it. He said some, I love that clip. Anytime there's market volatility, that clip on social media especially becomes like you see it more and more because of the wisdom that Peter Lynch just told us, right? So a few things that he mentioned, and then I want your guys' opinion on it. He said, and this was back in 1994, right? An old C-SPAN clip. But he said every 1 to 2 years, the market falls 10%. So expect it. Guess what the S&P yesterday was down 9 and change percent. The NASDAQ was down 11.5%. So that's that 1 to 2 years, right? Happened last spring during the tariff tantrum as well. But that's the first thing he mentioned. Then he mentioned every 6 years, the market will fall. And this is based on, again, 94 statistics, but it's going to fall 25%. So he says, expect it. And if you can't handle it, don't invest in the stock market. Right? So those were kind of some key points. But then he went on and talked about some important principles, and I want to throw it to you guys. What stood out to you, or what stands out to you every time you hear that clip from Peter Lynch? What stands out to you as, hey, the discipline process that Iron Gate has, or just light bulbs that continue to go off? Anything stand out, Brian?
Yeah, I think, what stands out to me is Peter Lynch talks about the opportunity that market corrections create. I mean, I think that's really the message that he's trying to, and that market corrections are normal and you have to expect them. And if you can't handle it, you can't handle the heat to get out of the kitchen. But when he talked about, I think, for example, a stock that was at 20 goes to 14. And if it goes back to 20, that's a pretty good return. But then if it goes to 6 and then back up to 20, that's almost triple your money if it goes back up. And so these market corrections can be a real opportunity. And I think, we've talked about companies that we've been owners of businesses that have had major corrections that we had, for example, and this is not a recommendation, but just Netflix a few years ago went through a major correction. Investors thought or that Netflix growth was over, and we felt like that was an opportunity. And now, knock on wood, I mean, it turns out that that was a great opportunity to hang on to Netflix and also to buy more. And we've had that with several other stocks, Meta a few years ago. And I mean, it's a regular occurrence. I mean, these things you have to expect. But I think ultimately the message from Peter Lynch is opportunity. These market corrections create.
Yeah, I love it. Opportunities right now. Just so you know, Facebook Meta is down from its highs 32%. Right. So, I mean, it's happening again. Nvidia, not that these are recommendations. Don't take them as that, folks, but down 20%. So,
20%.
Mike, what's the key though? If you own a stock from 20, it goes down to 7, which he says. What did he say? You like, what's the key in investing at 7? You invested at 20. Why would
And it
you
really
invest
is the key. It is the key, right? To not getting shaken out and to actually taking advantage of the opportunity of the volatility, right? And this is the key. So you have to understand what you own, right? You've got to know the company. You got to do some research. And it's one thing that we do here, right? Focus on the quality of the business itself, right? If there is, if the market decline is the result of maybe some structural change, does the management, right, the people who are in charge of that company, do they generally have a good track record for making the adjustments to continue profitability, right? So a good management team, strong balance sheet, right? And certainly one thing that you mention all the time is, a competitive advantage, right? If those things are in place, and I think this is really what he was getting at, if you know these businesses and you understand that these businesses carry those advantages with them, then those bear markets, they actually create the opportunities, right? And that's the difference between, and trust me, I'm still learning this because I'm an emotional guy. I think you know that, right? But it's the difference between losing money in bear markets and creating a lot of opportunity in bearish markets, right? It's knowing what you own.
Yeah, I love that. He says that if you know what you own, you can buy in at $7 versus 20. So
What the standard I think on Wall Street is most people take their cues or information. I mean, they act on trading information, meaning if the stock's down, there must be something that the market knows about this stock that I don't know, and hence I'm going to sell because the stock's not working. And we think about it a little differently, and I think that's one of the things that sets our process apart is we don't take our cues from the market. We do our own independent research and have an opinion why we own this company. And so when the stock does go down, and we've done our homework and we know, say, hey, we have confidence that the market's wrong, and that's where it creates opportunity. And of course, we're not perfect, and we make mistakes from time to time, but we feel like the due diligence that we put into these companies and the research we put into it pays off, especially when these opportunities arise.
Yep. I told a client earlier this morning as we had a conversation, Iron Gate in a extremely bullish market like what we had in 2021. I mean, clients are going to make money no matter where they are, right? No volatility, straight lower left, upper right year. The way that we differentiate ourselves as a firm to our clients is when volatility exists, because it can do, we can do exactly what you two just talked about. If we know the businesses and they're, they're trading at a discount, then now's the time to buy or buy more or change your allocation from 5 to 8, right? Because they're such a good deal. So, and that in turn allows us to compound clients' wealth, hopefully faster, no guarantees. But here's what's happening in the market right now. We've got a forward PE of about 19 on the S&P, on the S&P 500. And I'm going to pause there. When I say forward PE, for anybody that doesn't know, what does that mean?
So I'll give you an example. Let's say a company has $1 in earnings this last year, over the last 12 months. That means that you would pay $19 for that $1 of earnings. That's a 19 PE multiple. It's basically you just take the price divided by earnings, and that's how you get that PE multiple. It tells you, it's a reference point, a valuation point on, what are you paying for those earnings? And there's a lot of other things that go into it. For example, the growth rate of those earnings, the growth of those earnings, the certainty of those earnings over time. And, there's a lot more to it in a simple terms, you're just paying 19 times those earnings.
And generally, I'm going to speak generally, and thanks, Brian. But generally, if a PE, a forward PE on a stock is above the market, depending upon the stock, right, and future growth, broad statement here, above the market, that's a little bit more expensive. Below the market, it's cheaper. Is that fair?
That's fair.
Broadly speaking.
Yeah, that's fair. And that's really investors, they're making a statement. If you have a company that's trading at, say, 25 above the market, the investors are saying, hey, we think even at 25 times earnings, that this is still a good deal, a good bet. And then you have companies that say might trade at 15 or 10, and investors are saying this is an appropriate price for these earnings. And it could be for a number of factors: low growth rate, lack of certainty on those future cash flows, and things like that.
Okay, so here's why the market's dumb right now. Okay, I'm going to give you a couple forward PE on a few stocks. These are not recommendations, but this is why I love the market, because it can be dumb and provide the opportunities that Peter Lynch just talked about. Walmart, forward PE of 37.5. Okay, does that seem expensive to you guys?
It does to me. I mean, the PE multiple, that's why, Walmart's not really a core holding of ours, because I just think it looks pricey. It doesn't look attractive to me. In terms of, one way to think about that is a 30 or a 33 PE multiple is like getting a 3% yield on your money is what that's what it's like. And a 20 multiples is like getting a 5%. That's the inverse, not to get too technical, but that's the inverse. It's earnings over price. Earnings, it's like an earnings yield. And so you're getting 3% or less than 3% yield on Walmart. And that just doesn't seem very attractive to me.
So when the hits the fan, people want to buy Walmart. It's steady. It's just, hey, I'm going to put my money in Walmart or in Colgate or in Procter & Gamble. And they go to those areas of the market, which they've done, November, December through this month. And so here's a couple others that I'll throw at you. Mike, we've talked a lot about this one. NVIDIA, their earnings, Jensen Huang said from two chips, was it Blackwell and what's the other one? Rubin. Blackwell and Rubin. They're going to have $1 trillion earnings just from those two over the next year.
Sales, revenue,
Yep, revenue. Its PE right now, forward PE is 15. The cheapest the stock has been in 10 years. Is that cheap or expensive?
It seems cheap, especially on the expected earnings, right? So, right now, their current PE ratio, NVIDIA, is what, 35? Is that right? So
34,
that's a lot.
35.
That's
Yeah,
a
yeah.
lot of expected earnings
Yep.
that are kind of getting. It is point of reference, right? The current stock or the stock price now in reference to those expected earnings is very low, right? The current earnings, you're at 35 PE. The expected earnings, right?
Or
It's a much cheaper stock.
larger,
Exactly.
but the stock is cheaper.
Exactly.
Holy cow. Facebook, Meta, 15, Ford.
At 15 times, that's almost getting 7% current dividend, like a dividend yield. If they paid out 100% of their earnings, you get getting 7%. And then you have these companies like a Meta and a Nvidia that are growing those earnings at over 20%. I mean, so that seems like that there's a dislocation there. With
Yeah.
But the market, investors for whatever reason, they are doubting, they have doubts or fears about maybe those earnings or cash flows on Nvidia or Meta. So
Yeah. And we could be wrong, but
that's
and
the
that's
great
not
thing
the
about
recommendation.
market. Yeah,
But
yeah.
but those are some pretty cheap, pretty cheap. I mean, Google right now is trading at a market multiple. I mean, these are the opportunities that Peter Lynch talked about, which is, hey, if you know the businesses and there is volatility in the market, it's 6-year mark, right? And you're hitting whatever year market, it's down 25, 30%. Like, know these businesses. Those are stupid multiples. And take advantage of it when you can. I'll stop there. Anything to add to that?
I would just say this is that we're at a market that's kind of tested that 10% down, right? And we're kind of going back to these fundamentals, these ideas about the reason why you're investing, right? Know what you own, right? If the market drops another 10%, how are you going to feel then? And
I
here's
know
what
how.
I find interesting about you, Brett. Some of the times I see you the most excited are on just big down days in the market,
Oh,
right?
man.
And that's just kind of remembering kind of the philosophy of what you're trying to do here,
Yeah.
right? The down moves, right? If we drop another 10%, there's going to be a lot of pain, a lot of anxiety. But as long as you know what you own and the financials are still good, well, then that even means potentially greater opportunity, even though it won't feel like it.
Brett's energy is kind of hard to
Can't match it.
match. Nobody can like keep up with him. He's got tons of energy. He's always
I'll tell you what,
optimistic. Yeah.
and I truly believe this. Iron Gate differentiates itself in times of volatility. And leaving political ideology by the wayside, I love the tweets because they create volatility. And I love volatility because it differentiates ourselves from our clients. So,
well, you'd get the volatility anyway. That's kind of what markets do. So I'm not sure I'm fully on board with you there, but I see what you mean.
Hey, keep the Burry tweets coming then, Mike. You know what I'm saying? It doesn't have to be Trump. It could be Burry, our boy Burry.
Hey, Brett, but we love that, you can look at a company like Meta and we're like scratching our head saying, well, this seems way too cheap.
This is dumb, yeah.
Or Walmart. But that's what makes a market, right? And that's what creates opportunity. And it gives us an opportunity to hopefully create value for our clients. And if we do our homework and do our research, and if we're right, then it will be good, So, but that's what creates markets, and that's what I think gives us an opportunity to create value for our clients.
Yeah. That's why I love the market. And you're right. If the market goes down another 10%, we will certainly communicate with clients, but I will love it because I know that in the next 5 years, our clients will be able to compound their wealth because of the actions we take better than just riding the spoos, right? The S&P. Like that's just what we do. So,
yeah. I mean, and history's on our side. I mean, every market correction has been a temporary market correction. Now, some lasted a long time. If you look at the correction in 07 and 08, I mean, that lasted a long time.
Yeah.
But every market correction is a temporary correction, and I still believe that companies will continue to compound and grow and increase their increase their value, and that's why we feel like these are opportunities.
Last question, and this just came to my mind. I've been, I watch CNBC, of course, Bloomberg, and all these interviews with portfolio managers, and they often are asked this question: are you bullish, bearish, or neutral? And I think it's a really stupid question, but here's what I've heard. And then I'm going to pose the same question to you. I've heard this a lot. I'm kind of neutral. That's what they all say, right? I'm neutral because they don't know what's going to happen. And so they want to sit on the fence. I'll ask you first, Brian, bullish, bearish, or neutral?
I would say that I'm always on the side of bullish. I mean, and I think maybe that doesn't sound great, but the reason why is I'm always looking out 3 years, 5 years from now. I don't really think in terms of how's the market going to end up this year. That's not my focus. My focus is owning a business that's going to do well over the next 3, 5, and 10 years. And I'm sort of agnostic about what's the market going to do tomorrow or the next 3 months or the next 6 months or this year. I don't spend a lot of time thinking about that. Now, of course, I pay attention to it, and I know that the market's down, year to date. And I know all that stuff, but I'm looking out long term, and so in those terms, I'm always looking for opportunities to buy a great business at a great price.
Yep, I love it. Agnostic, but almost a permeable based upon.
Yeah, which doesn't sound great,
Yeah.
but I'm thinking,
you know what?
thinking
That
3
sounds
years
good
out.
to me.
I know, but I'm thinking, but
I think Peter
sometimes
Lynch would say something like that, honestly.
Yeah, but sometimes
Yeah.
people are critical of the permeable. They're like, oh, he's always permeable. Well, I guess a guilty, I'm guilty as charged there. But again, I'm not thinking in terms of what's going to happen in 2026. I'm thinking what's going to happen in 2029 or 28,
Yeah, and buying great assets at good prices. Yep.
Right.
Okay, Mike, bullish, bearish, neutral.
I liked Brian's answer.
Yeah.
I always tell people I'm net long. It's not a recommendation, but I'm always net long.
Which is bullish.
Just structurally, that's what the market's designed to do, is to go up. And we talk a lot about statistics and history, right? At least we have a segment about that usually in this podcast. And what you find is that those declines, the market winds up going higher, right? That just historically, that's what it does.
Yep. Amen. I love it. I'm a permeable, and I'm darn proud of it. If the market historically is up 75% of the time, why would I try to make money on 25% of any down move? Like, it's too hard. Stop. Just buy great businesses at good prices.
Brett, you're a probability
the long-term mindset, right?
Yeah. Yep.
And Brett, you're a probability investor, and the probabilities are over time, stocks will go higher. So it makes sense.
Yeah. And I'm an optimist. You guys know that. And sometimes that's my downside, is I'm an optimist. But I believe, Brian, you got an American flag behind you. I believe in American ingenuity, right? Why would I be bearish against that?
And who wants to go through life being a pessimist? It's no fun.
No. Amen, brother. Amen. All right. So there we go, my friends. Don't be a pessimist, be a permabull. What else did we learn today? Michael Burry has covered his shorts. And most importantly, take advantage of the volatility. Yeah. With that, my friends, anything to add?
It's great.
Peter Lynch is a Red Sox fan. Sorry.
We better end that right now, my friend.
Yeah. Anyhow.
He's a Boston guy.
Yeah.
Of course, that makes sense.
You had to ruin the whole podcast. Well, if I ever need some toilet paper, I'll ask to use his Boston hat.
Oh.
Just kidding to my Boston friends. I'm kidding. We could be friends still. With that, everybody, hope you have a great Easter weekend. Until next time, bye now.
Bye.